Hi everyone, and thanks for joining. In case you forgot, we're working our way through the fund development planning process. The first step in the planning process is to evaluate your current fund development operation. Part of this step involves evaluating each individual fundraising channel. Over the last 3 segments, I walked you through how to evaluate your annual, major, and planned giving channels. These are the fundraising channels that exclusively focus on raising money from individuals. The remaining channels to evaluate are special events, corporate giving, and foundation giving and governmental relations. Special events are social gatherings that raise money for nonprofit organizations. Special events are commonly used by small nonprofit organizations and hospitals, and less commonly by higher education institutions, as part of their overall fundraising strategies. Galas and sports tournaments are the most common types of special events. For the purpose of this video series, I'm only going to be referring to special events as those events where the main goal is to raise money for the nonprofit organization. It's okay to hold special events with a negative ROI if you're achieving another organizational goal. I've ran special events personally that were free to attend because we were trying to expand our prospect base. But I'm only addressing events that are intended to raise money in this video series, since they are very different events, especially when it comes to strategy. Special events are advantageous for several reasons. First, they allow you to raise money while also achieving other organizational goals. For example, many nonprofits use special events to increase their visibility and name recognition in the community. They also get to educate attendees about what their organization does and brag about their accomplishments. Special events also support the fundraising cycle in a number of ways. Events are one of the most common ways that nonprofits identify new prospects. Up until now, I've been using the term prospect to refer to an individual person who is a prospective donor. Now that we're expanding beyond individual fundraising efforts, the term prospect will refer to any potential donor, including individuals, corporations, or foundations. Special events are often planned with the assistance of a steering committee made up of volunteers. This group of volunteers works with the designated staff member to plan and execute an event. In addition to helping to plan the event, these volunteers are responsible for developing the prospective attendee list for the event, inviting and/or soliciting their personal contacts, and identifying and/or introducing staff to potential sponsors. This is also a great way to engage volunteers in fundraising. In addition to identifying potential prospects, events may be used to cultivate existing prospects. Sometimes nonprofits will offer complimentary tickets to high-level prospects as a cultivation move. Once at the event, there are usually ways to continue cultivating the prospects. For example, when I was raising money for low-income youth, I would seat prospects at the same table as some of the kids who were benefiting from funds raised. Special events also support the solicitation stage of the fundraising cycle. Corporate solicitations are often centered around special events because of the recognition and benefits they offer. We'll discuss corporate giving in the next segment, but it's important to note that businesses often give in the form of event sponsorships because they get recognition as well as tax benefits in return. Stewardship is also an important function of special events. Many nonprofits use special events to steward their top donors. Lots of times you see an event centered around an honoree. You'll also see pamphlets and signs at the event listing top donors. Now that you understand the purposes of special events, I'm going to be honest, I'm not a fan of them. They're costly, they have a low return on investment, and are extremely labor intensive for staff and for volunteers. But I've watched many nonprofits continue to run special events year after year in spite of these costs. What I found is that they're scared to eliminate a fundraising channel that is bringing in any revenue, even if it's a small amount, because they're worried they won't be able to raise the money without the event. But I'm going to help you to face that fear and become even more profitable. Don't misunderstand me though, not all special events are bad. Some are extremely successful and are vital to the success of the recipient nonprofit. I want to help you to maintain your successful events, improve the events that are worth saving, and to recognize when and how to eliminate events without losing the revenue from them. You need to be ready to make tough decisions about cutting special events as we move forward in this process. If you go into the evaluation process with your mind made up about keeping events, then you aren't going to get anything out of this. On the other hand, if you remain open-minded and let the data drive your decisions, just like I've been teaching you, then you'll optimize your special event and overall fundraising strategies. Step 1 in the evaluation is to conduct an analysis of return on investment. First, I want you to make a list of the special events you hold each year. Then we'll start with the revenue analysis for each event. There are 4 main types of revenue that nonprofits receive from special events. The first is from ticket sales, where people purchase individual or group tickets to attend. The second type of revenue is from event sponsorships. There are usually different levels of sponsorships offered, and each level has corresponding benefits attached. Corporations are the most common prospects to sponsor events. In return, they often receive visibility in the form of public recognition for their contributions. Third, sometimes gifts in kind are provided. These are items that you've budgeted for, but that someone donates or underwrites. For example, let's say your nonprofit wants to hold a gala at a hotel, but the hotel agrees to provide the space at no cost. You're not actually receiving a donation from the hotel, but it does cut your event expenses and therefore increases your profit margin. And lastly, there are the miscellaneous revenue sources. Often there will be auctions at special events to increase revenue. Sometimes attendees just make donations during or after the event. Others send a check instead of attending. All of this counts towards the total revenue. So start your ROI analysis by listing every event along with the following revenue information: number of individual tickets sold, total ticket revenue, total number of sponsorships, total sponsorship revenue, total value of gifts in kind, total revenue from miscellaneous sources, and the total revenue. Next, you need to analyze the costs of each event. The types of expenses will vary based on the type of event, but some will remain consistent. List out each event and note the following information: the total value of staff time required, the cost of the venue, cost of food, cost of marketing, all other expenses, and then I like to break out the total expenses by with staff time and without staff time, so you can see how many man hours are being spent on each event. Now you remember how to calculate return on investment, right? Revenue minus expenses and then divide by expenses. For event analysis, you'll also want to compare revenue, expenses, and return on investment for the past 3 years. This will help you to identify the event trends. Here's an example using event number 2. I've noticed that in recent years, expenses have been increasing while revenue from special events has been remaining the same or decreasing, yet nonprofits keep holding those events. As I said earlier, you need to be objective about what's working and what isn't when evaluating your fund development channels. Based on these analyses, you'll know if your events are financially successful or not. But as I've mentioned, there are other factors to consider. Therefore, you need to determine if events are achieving their non-monetary goals. In order to do that, you need to look at some additional factors: the type of event you're holding, the goals of the event, and I haven't put it in this slide, but you also need to identify the metrics that tell you if the goals are being met. For example, if your goal is to increase prospects, you need to look at your database and find out if the event has actually led to more prospects being identified. As you assess your special event fundraising strategy, I strongly recommend speaking with the staff and volunteers who are involved with the event. They will likely have important insight that can't be uncovered through objective statistics and analysis. It can also be helpful to survey current and prior attendees and sponsors to obtain their feedback. Based on this information, your ROI analysis, and your institutional knowledge, You're now armed with the information you need to make decisions about what to do with special events. You have 3 options for each event. Keep an event without major modifications, keep an event with major modifications, or eliminate an event. First, let's look at when to keep an event without major modifications. Even though I'm not a fan of special events, I recommend keeping those events that are achieving your non-monetary goals and maintaining a consistent level of profitability from year to year. The acceptable level of profitability will depend on the events. The industry standard is that a maximum of 50 cents per dollar raised from an event should be spent on the actual event. Even if you decide to keep an event without major modifications, I do recommend that you still look for ways to improve. There's always room for improvement no matter what. Just remember to let the data drive your decisions. Event number 1 is a good example of an event that should be kept without major modifications. The event is profitable with 122% return on investment. The event is bringing in $200,000 in revenue, which is more than double the revenue of the other 2 events combined, which is a big deal. The only problem that I see is that the expenses are pretty high, and the largest expense of $50,000 for the venue is covered by 1 corporate sponsorship. Yes, $50,000 is a large and generous gift in kind, but what happens if that gift doesn't come through one year? If you want to grow the event, what happens if that venue doesn't have the capacity to fit the number of attendees you want to have? All of a sudden, your profit is decreased by $50,000, which is 25% of the gross revenue from the event. Now that we've looked at the monetary goals, let's talk about the non-monetary ones. To determine if this event is achieving its objectives of stewarding donors and cultivating prospects, it would be helpful to get feedback from event attendees. I would also analyze the giving patterns of event attendees. Even though we say that the goals are to steward prospects and cultivate them, we know that the ultimate goal is to raise money. So do some analysis and see if event attendees increase their giving at all. That will help you to determine if you've met your non-monetary objectives. You should also look at the attendees and determine if they fit into your target audience. If your goal is to steward current donors, but most of the people attending have no affiliation to your organization and are only there because their company bought a table, then you haven't achieved your goal. For the purpose of this analysis, we can assume that this event met its non-monetary goals. Overall, this is a good event that should be kept without any major modifications. The next option is to keep an event but make major modifications to it to try to make it worth keeping. This is for those events where there's potential in the next year or 2 to get the event to a point where it's meeting its monetary and non-monetary goals. This should only be used for those events where you can pinpoint the reasons that they're not achieving their goals and know how to address them and actually have the resources to address those plans. You also need to draw a line in the sand and decide when it's time to give up. For example, you could decide that if you cannot decrease the venue expense by half this year, then you won't do the event again in the future. You can also decide that if you don't sell 100 tickets at $200 a piece by 90 days prior to the event date, then you'll cancel the event. Sometimes you have to just cut your losses and prevent the waste of time, money, and other resources. I'll show you what I mean in event number 2. This event is at the maximum revenue to expense ratio. Normally, I would recommend that any event that spends 50 cents of every dollar raised on the event itself needs to go. But I do see potential here. As you saw in the year-over-year analysis, this event has been increasing profitability over the last 3 years and could become even more profitable if it's restructured. There are 2 ways to improve profitability: increase revenue or decrease expenses. As you can see, the majority of revenue from this event comes from sponsorships. Businesses usually sponsor events in part because of the visibility they receive in return. In order to get a business to sponsor an event, you need to be able to show them that they'll get visibility among their target audiences. They also need to believe that the value of the visibility they will get will be worth the money that they give. That's why it's important that an event like this, which relies so heavily on corporate sponsors, attract a significant number of attendees each year. That's why this nonprofit needs to find a way to boost the event's attendance. It may be a good idea for them to lower the ticket price a bit to attract more participants. On the expense side, the two biggest expenses are staff time and the venue. For the venue, it may be possible to get a discounted price, but I honestly wouldn't count on that. Your efforts would be better spent trying to reduce the amount of staff time spent on this event. The first and best option would be to rely more heavily on volunteers instead of staff. Or perhaps, and I've seen this, the volunteers are the ones straining your staff resources. Most of the time, volunteers are a wonderful resource, but the other times they can be counterproductive. You may need to consider politely firing volunteers or even hiring an outside vendor to run the event. These are just a couple of brief examples of ways to restructure the event. When money is on the line, you'll want to assess every aspect of the event and make decisions based on what you find. But if you do recommend keeping an event that you'll be making major changes to, you have to know what the changes are going to be and be prepared to actually make them. You can't just say, we'll raise more money from sponsorships. That doesn't work. How will you raise more money from sponsorships? Who are you going to target? If you don't have those sponsorships secured by a certain date, will you cancel the event? If you're keeping an event with major modifications, you also need to consider your non-monetary goals. In this case, the goal is to identify new prospects. To determine if the event is actually meeting that goal, you'll need additional information. First, gather information about how many new prospects you've identified through this event. More importantly, determine the number and percentage of these prospects who have actually turned into donors to your organization. Analyze the giving information to determine what type of short and long-term value these donors have to your nonprofit. Lastly, if you do choose to get rid of events, you need to make sure that you're able to achieve your monetary goals and non-monetary objectives through other initiatives. And you also need to make up the potentially lost revenue. Let's take a look at event number 3. You may look at the overview and think, event 3 raised the same amount as event number 2 and actually had a higher ROI, so we should keep it if we're keeping event number 2. Well, guess what? That's the wrong answer, and this is why we don't just look at the overview and make decisions. Sure, you're profiting $20,000 from the event, but you're actually getting a $30,000 donation from a sponsorship. Let's assume that this was a corporate sponsor. How do you think that business would feel if they learned that they gave you $30,000 and you managed to turn it into $20,000? I guarantee that they wouldn't give you another cent if they knew that. First of all, you never want your revenue to be that concentrated. You know how financial advisors always tell you want to diversify so you don't lose all your money? Well, the same concept applies here. The solution is clear. As long as you can find a way to retain your corporate sponsor, get rid of the event. Of course, you would need to make your corporate sponsor part of the discussion before making any final decisions, since you don't want to lose that $20,000 profit. You need to figure out what their objectives are, and if there's another way for you to help them to achieve those objectives. Perhaps there's another event they can sponsor, or a project they can support and put their name on. Be creative. Think about it. Even if they decrease their donation by $10,000, you would still net the same amount of money for a lot less time and effort. As far as the non-monetary goal goes for event number 3, the goal is much too vague to even try to measure. This may have contributed to some of the event's failures. How do you measure the goal of increasing visibility? That's not as easy as measuring new donors. Well, when you set a goal of increasing visibility, you need to specify where you are trying to increase the visibility. Are you trying to increase it in the county where your nonprofit is? In the city? Where? You also need to explain what you want to achieve. Do you just want name recognition? Do you want people to know about the services you offer? Always be specific when you're setting goals. When you set those goals, you should also specify how you're going to measure them, especially with something subjective like increasing visibility. Lastly, I just want to mention that there are a few cases when you may actually want to add special events. You should never add a special event because you need money or have a budget gap that you want to fill. I've taught you better than that. Here are the criteria that must be met if you consider adding a special event. First, there must be a clear purpose. Second, there also needs to be sufficient staff and volunteer support. Third, the target audience can't be targeted by other events or fundraising channels. Fourth, you aren't competing with other events. And fifth, the target audience needs to have sufficient capacity that the event could be successful. I hope that you found this segment helpful as you evaluate your own special event fundraising channel. Please feel free to email me if you have any questions about this topic. Until next time, thanks for tuning in.